Sarah Borges-Quito, and in conjunction with NAREIT's REIT World 2020 Annual Conference, I'm speaking today with Mike Landy, President and CEO of Monmouth Real Estate Investment Corp. Mike, thanks so much for joining me.
Thanks for having me, Sarah.
So tailwinds were already in the industrial sector's favor pre-pandemic. Can you talk about how things have changed or perhaps even improved since March?
Sure thing. There's no question that e-commerce was the strong tailwind that the industrial sector has been riding since the turn of the century. As a result of the COVID-19 pandemic, the growth of e-commerce has soared. The lockdown, stay-at-home environment has created a need to shop online. And so our largest tenants, FedEx and Amazon, are experiencing peak season, Christmas holiday season-like demand ever since the pandemic hit. Record revenue, record shipments. It was estimated that U.S. daily package shipment volume would reach 100 million packages per day by 2026. That's been pulled forward, and it's now estimated we'll be shipping 100 million packages per day in 2023. So there's just tremendous demand for shopping online. The Christmas season is coming. It's going to be the peak season of all peaks. There's been several articles written that the network cannot even handle the demand this holiday season. Right now, the total logistics network in the U.S. can handle about 80 million packages per day, and it's estimated this holiday season demand's going to be 10–20% above that. So they're already turning away business for the holiday season. It's just demand is above capacity. From a landlord standpoint, these are not bad problems. These are actually good problems, and we're working with our tenants to enhance their capacity, doing property expansions, and certainly the buildings are very essential for our tenants.
What are your expectations for M&A activity in the industrial sector for 2021, and how will pricing be for individual assets?
Well, M&A in the industrial sector has been very prevalent for several years. There's been a lot of portfolios that have changed hands, and the public market's become indexized in that the ETFs favor growth for growth's sake. So as big companies get bigger, their cost of capital comes down, and it's very accretive for them to acquire a smaller company. You need two interested parties, and to the extent that the larger companies are willing to pay large premiums, that will generate the willingness from the other side. Conversely, the smaller companies do have an advantage in that, for instance, we have two large acquisitions we're going to be closing on very soon, and they will move the needle substantially. So a smaller company, each acquisition moves the needle. A smaller company also has the advantage that they can focus on the best tenants, the best assets, the best locations, and a larger company cannot adhere to the stringent requirements that we can. And so I think that's borne out by the fact that our occupancy is the highest in the sector, our rent collections are the highest in the sector. So while we're not one of those companies that grows for growth's sake, from a qualitative standpoint, I think our performance stands out.
Related to rental renewals for 2021, what are you learning about in those conversations with tenants?
You know, we have largely investment-grade tenants. Over 80% of our revenue is secured from investment-grade tenants. So it's important that we have high tenant retention. Historically, we average around 90% tenant retention. Last year was about that. It was 87%. 2021, we're shooting for 100% tenant retention. Like I said, our buildings are essential to the economy. They're mission critical to our tenants. And so given what's going on with industrial and the demand from e-commerce, it's highly likely that we'll achieve above 90% and hopefully 100%. Our leases are long duration leases. They go out over 7 years. So you have only about 13% of the portfolio rolling in any given year. So we pride ourselves on high quality earnings, high quality cash flow, with our tenants being investment grade and our leases going out long term. There's a quality of earnings that you want to protect by retaining your tenant base. Now, earlier you asked me about pricing, and I think I skipped the answer to what I thought about pricing. And with regards to pricing, you know, it's clearly a seller's market. Cap rates are at record lows, and everybody wants to be exposed to the industrial real estate sector. but there is a huge increase in the money supply. The government deficits are at record levels. Public debt is at record levels. So there could be serious inflation coming down the road. And with inflation, these record low cap rates and highest prices per pound won't look so unreasonable if there is inflation. So we're growing steadily. We have a pipeline of about $340 million in acquisitions, all leased to investment-grade tenants, and that will grow our earnings. And we'll have to see what happens as far as inflation and how that plays out down the road. But it's been a long period of very benign inflation, but a huge increase in the money supply. So we're being careful about what our exposures are.
Mike, thanks so much for joining me.
Thank you very much.
And for more news and information from REIT World, be sure to visit NAREIT's website, REIT.com.